It's no secret that inflation has had an impact on the housing market, and a recent survey from Real Estate Which has confirmed that among millennials, 92% of those who were planning to buy a house this year have felt the effects. But fear not, dear millennial homebuyers, because most of you aren't letting inflation stand in your way. According to the survey, while some of you may be delaying your buying plans, 28%, the majority of you are finding ways to work around inflation. 59% of you are saving more money for your purchase, 36% are spending more than expected, 26% of you are opting for fixer-uppers, and 25% are going for a smaller home. It's important to note that millennials, who are currently in their prime home buying years, make up a significant portion of the home buying market. According to the National Association of Realtors, the typical first-time homebuyer was age 36 in 2022, which is up from age 33 in 2021. In 2021, first-time buyers made up 26% of home purchases, compared to 34% in 2022. This increase can be attributed to the year-over-year double-digit price jumps for much of 2022 and rising mortgage rates, which created an affordability problem for many buyers. But the situation is gradually improving as home prices continue to slide. According to the Realtors Association, the median price for an existing house was $366,900 in December, just 2.3% higher than a year earlier and down from $370,700 in November. Last June, the median price was $416,000, 13.4% higher than in June 2021. Furthermore, interest rates on mortgages have also eased, with the average for a 30-year fixed-rate loan being 6.21% as of January 24, according to Mortgage News Daily. This compares to 7.32% in late October. So, as all buyers know, the higher the rate, the more your monthly payment is. While it may be tempting to hold out for rates to drop to the incredibly low levels we saw in 2020 and 2021, experts are warning that those days may be behind us. Lawrence Yun, chief economist for the National Association of Realtors, advises buyers to shift their mindset and accept that a rate of 5% or 6% may be the new normal for the foreseeable future. This is due to the fact that the ultra-low rates seen in 2020 and 2021 were a result of emergency actions taken by the Federal Reserve to support the economy during the pandemic. It's unlikely that we'll see a return to those rates in the near future, as they were an anomaly caused by exceptional circumstances. As the real estate market continues to heat up, buyers may find themselves facing a new challenge: limited choices. Despite a slowdown in the housing market, houses are still selling quickly, with a 2.9-month supply of homes as of last month. This means that at the current sales pace, it would take just 2.9 months to sell all listed houses if no more came on the market. While this is an improvement from November, when there was a 3.3-month supply, it's still below the balanced market level of 4 to 5 months, according to Redfin. This lack of inventory can be attributed to the high demand for housing, as well as the fact that many sellers are hesitant to put their homes on the market during the ongoing pandemic. But for buyers, this can mean a more competitive market and a need to act fast when a desirable listing comes on the market. As Lawrence Yun, chief economist for the National Association of Realtors, puts it, even with the housing slowdown, days on the market are still less than a month. That implies that people in the market to buy are finding a listing they want and snatching it up quickly. It's true, the housing market is always a fierce competition, but if you're looking for a buying opportunity, it might be worth looking at homes that have been on the market for a little longer. According to experts, listings that have been up for a month or two may just be the ticket to a great deal. These homes may have been passed over by other buyers, and the seller may be more willing to negotiate on price. In fact, some sellers may be willing to take as much as 10 to 15% off the list price. But it's not just the price that could work in your favor. With the current market, sellers are more likely to agree to contingencies like home inspections. So, while you may have to be a little more patient in your search, it could pay off in the end. As Stephen Rinaldi, founder and president of Rinaldi Group, says, waiving the appraisal and waiving of inspections really walked hand in hand with low interest rates. So, be patient and keep an eye out for those homes that have been on the market for a bit longer. They just might be the key to your dream home. When it comes to buying a home, there are a few things to keep in mind. Firstly, It's important to understand that except for in premium areas, in most cases sellers are now back to allowing contingencies, according to Stephen Rinaldi, founder and president of Rinaldi Group. This means that buyers can once again make the final sale of the home contingent upon things like a home inspection, which can give you peace of mind when making such a big purchase. Another thing to consider is expanding your search radius, particularly if you're looking at homes close to a city. According to Lawrence Yoon, chief economist for the National Association of Realtors, there are often more affordable houses further out from the city center, and these homes tend to stay on the market for a longer period, which can be a great opportunity for buyers. Lastly, if you're looking for ways to bring the cost of your mortgage down, it may be worth considering an adjustable rate mortgage, or ARM. With an ARM, the initial rate is lower than a traditional fixed-rate mortgage, but it adjusts up, down, or remains the same, depending on interest rates. This can be a great option for buyers who don't plan on staying in their first home for a long period of time, as the rate will adjust by the time they're ready to sell. However, it's important to note that there's a limit to how much the rate can change, so experts recommend making sure you be able to afford the maximum rate if faced with it down the road. And if you're considering an ARM, Rinaldi suggests looking for one whose introductory rate is at least a percentage point below fixed rates, depending on your situation. In conclusion, it's important to keep in mind that 5% or 6% may be the new normal for mortgage rates, and buyers should not wait around for rates to drop as low as they were in 2020 and 2021. Additionally, it's important to consider that houses are selling quickly and that searching for homes that have been on the market for a month or two may be a great opportunity for a better deal. An adjustable rate mortgage may also be worth considering, as it offers a lower initial rate compared to traditional fixed-rate mortgages. Remember that it's important to evaluate your options and make sure you can afford the maximum rate if faced with it down the road. If you found this information useful, don't forget to subscribe to Wealth Builders, like the video and share it with your friends. Thank you for watching.